Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the final session of our Summit on Options and ETFs presented by the Options Industry Council. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us. In this fourth session of the day, we're going to switch gears and hear from representatives of 3 different options exchanges, so we'll be discussing different strategies on options and ETFs that could fit your investing needs. We'll be covering the material, as well as your questions, in a quick 60-minute session. Our moderator today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of options and investments to our discussion. And, as I mentioned, we have 3 panelists. Peter Lusk is a senior instructor at the Options Institute, the educational arm of the Chicago Board Options Exchange. In addition to his responsibilities there, Peter serves as an instructor for the Options Industry Council. Prior to working at the Options Institute, Peter was a highly successful market maker trading equity options on the floor of the CBOE. Barry Nobel is a vice president with Nasdaq and is part of the senior management team of the Nasdaq option markets. Previously, Barry was vice president of marketing at the Philadelphia Stock Exchange. Barry has also served as the general partner at Nobel Securities, a proprietary trading firm that traded at PhilX. Bill Ryan is a managing director at NYSE Options. Bill began his career with E.F. Hutton in 1982, where he served on the retail trading desk. At NYSE, he is responsible for business development and sales for option products, new product development, and options education. In addition to his responsibilities at NYSE, Bill also serves as an instructor for the Options Industry Council. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Our panel will be responding to those questions during the end of today's session, so make sure to stick around for our entire webinar. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there's a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And now, ladies and gentlemen, Joe Burgoyne will moderate our discussion today, the Options Exchange Strategy Session. Joe?
Nick, great job, and thanks so much. And again, thanks to everybody for attending round 4 today of 4 rounds. Happy to be coming to you live, and really happy to be changing up the way we do this particular presentation with friends and colleagues, Peter Lusk, Barry Nobel, and Bill Ryan. And before I bring those guys in, just a couple things I want to go through, and that is, of course, that the OIC and the industry offer a copy of characteristics and standardized options that you can get either from the OCC or from your broker. Also, some of you may not know actually who the OIC or the OCC are. OIC was founded in 1992 as an educational cooperative funded by the OCC and the exchanges. The OCC is the world's largest equity derivatives clearing organization and the foundation for secure markets. OCC actually is now providing central counterparty clearing and settlement services to 16 exchanges and trading platforms for options, financial futures, security futures, and security lending transactions. So it's a group effort here between OIC, OCC, and the exchanges that are listed there. We've got the BATS, BOX, CBOE, ISE, MIAX, Nasdaq, and New York Stock Exchange that help to fund the OIC initiative. For those who have been on some of our OIC webinars, you know darn well this is one of my very favorite slides, and it speaks to the growth of the listed options industry, which started in '73 at the Chicago Board Options Exchange. 16 underlyings that day, 928 contracts traded, to a point in the industry now, 40 some odd years later, where we are over 4,200 underlyings, trading close to 17 million contracts a day. So it's an industry that's had a great growth story, and our focus today and all day long has been, the growth in ETFs. So where option volume from around 2006 has a little bit more than doubled from 2 billion contracts a year to about 4.3. The ETF volume since 2006 has more than quadrupled. And again, that's why a lot of our focus today has been on the whole ETF space. Different reasons for growth in the options industry, combination of a number of things. Institutions have become more and more involved for various reasons in this low interest rate environment. Certainly the idea of generating generating income with different strategies coupled with different risk management techniques. The coordinated industry educational effort for both retail and institutional investors, as well as financial advisors, has been paying off over these last few years. The fact that the exchanges, we obviously have access in electronic capacity going back to the foundation of the ISE back in 2000. Access to the markets in electronic capacity has helped. Pension plans more and more involved. So as I said, over 4,200 stocks at this point, indexes and ETFs, and well over 800,000 different series for you to choose from. So for those of you who are brand new to options, really there are two, maybe three key reasons why investors use options: reducing risk, income generation. Some, but not sure how many, actually can use options for speculation because of the leverage component, where each option corresponds to 100 shares of the underlying. That's really why we use options. And this slide represents 18 different strategies between Peter, Barry, and Bill. Maybe we'll talk 18, maybe we'll talk 28. Who knows tonight exactly how many we'll get into. But the important thing about this slide is that those solid blue lines represent the risk profiles. Some suggest minimal risk, others suggest really unlimited risk. And we thought that the format for today, bringing in three seasoned professionals to talk about different types of strategies, the benefits, the risks, in the three types of movements in our underlyings, bullish, bearish, or neutral, would be the way we would keep you interested, I hope, for the next 45 minutes or so. So with that, I'd like to bring in Bill, Peter, and Barry, and maybe Bill, I'll start with you. Pick an ETF that you have an opinion on, bullish, bearish, or neutral. Why don't we start talking an option strategy or two?
Sure. Thanks, Joe. I'm happy to be here. I always enjoy doing these seminars, and I like to start with this slide here. I think it's a great slide with the ETF up, down, or sideways. You have a forecast. How bullish or how bearish are you? So I like to tell people that your strategy depends on your situation, what you think of the underlying ETF, and exactly how you think about that. So I'm bullish. How bullish am I? I'm bearish. How bearish am I? Slightly. Am I more towards neutral side? But I like to go with the bullish side. Let's say I'm very bullish on an ETF. So the first thing I think of is I'm very bullish on this ETF. I'd like to look at buying a call. It's the most simple of the speculative strategies. I'm going to buy this call, participate in the upside when the ETF goes up, and I have a defined risk. And the most I could lose is what I pay for that call. I have a break-even point that I have to get past, which is the strike price plus the premium I pay, and I have unlimited upside above that break-even until expiration. I think it's a great place to start. And I define that from the beginning to the end, and there's all sorts of things that can happen in the middle. And maybe Peter or Barry can hop in here and tell us what can happen in the middle, or maybe have a different idea what we can do.
Well, I'm looking at. Go ahead.
Go for it, Peter.
Yeah, I think the next slide is a great slide to piggyback on the one that Bill just talked about. The next slide, I believe, we're looking at is a bull call spread. I like to think of this as having realistic expectations. The slide that Bill talked about was basically buying a call option, unlimited profit potential on the upside, and it pretty much reminds me about some of the traders that I deal with that they get the green dollar signs in their eyes and they think that the ETF is going to go to 1 million. Not really, we all hope so when we put a trade like that on, but I like to choose a strike price with the call that I'm buying, and then perhaps sell another call up on top where I think the ETF might go during my time frame that I'm looking at. And again, the toughest thing is what is the underlying going to do? And it all comes down to a 3-part forecast, really. What is the underlying ETF going to do? How long it's going to take to do it? And then there's always the expectation of volatility as well, because remember, when we're buying options, we're buying volatility and time. And when we're selling options, we're selling time and volatility. So spread strategies spread off that risk to a certain degree.
Hey, Barr, how about
Yes, sir.
Are you a bull call spread type guy? Do you like straight calls, selling puts? When you talk bullish strategies, do you have a favorite approach?
I don't have a favorite approach, and that's what I find so useful about options. It gives you, options. Not to sound corny, but they give you options. So I don't have a favorite approach, but sometimes I read an article, as I read this morning, and they were talking about the economy of Brazil. I'm still with you guys, right?
Yeah. Oh yeah.
Yeah.
Good. Okay. So I'm reading about the economy of Brazil this morning, and the Brazil ETF shares down, forecasting the worst recession in the century. Okay. They're talking about, equities have declined 37% year to date. 10% over the last week. They're talking about the GDP, gross domestic product, being down 4.5% year over year. The economy is shrinking. The inflation has jumped over 10%. So they're talking about the worst economy they've seen in 100 years. Now, people look into it saying, well, I want to get in. This is the greatest time to get in. Others think that there's nothing positive in the news, so they want to sell, or they want to take advantage of the slowing economy down there. And there's no right way, there's no favorite way that I have. But if you wanted to get in, instead of, putting, and let's say it was just trading for EW, I'm not supposed to say anything, but let's just say this product was trading at $22.50 today. You can use options to say, well, if it gets down another 10% to 18, I'm happy to buy it. So in that case, if you want to be bullish, you can just sell a fully funded put. And it's being paid. It's kind of like being paid to put a limit order in. So I like the idea of spreads and doing so there's not unlimited risk. But I also like, other times it depends on what your strategy is and what feels right to you and what feels right to, and what kind of risk tolerance you really have. Instead of just going out and buying.
Yeah.
Go ahead. I'm sorry, Bill.
No, if I could, I just want to jump in. I agree with you, and I'm glad you brought that up, because I look at if you're a raging bull, you're buying the call, you get the greatest leverage. But Peter brings up the idea of the spread and said it's a realistic view. Like, very few people buy an ETF and watch it go from 25 to 80. So Peter's view is, this is a really realistic view of what's going to happen. Yeah, it's going to go from 25 to maybe 34, but it's not going to break 35. So I'm going to sell that 35 upside to somebody else. And then what you're saying is great. I mean, here, if it comes down, I'll buy it. If it doesn't come down, I get paid to wait to buy it. Maybe I don't buy it, but I get paid to wait to buy it. So I think exactly what you said. It depends on how you feel about it. And here's three great ideas for three different situations, three different risk tolerances, and three different ways of looking at a bullish idea.
I want to go back a little bit, Bill, to something you said, the long call and the break-even point. So if you buy an out-of-the-money call, and why don't we go back to Barry's stock price at $22.50, so you buy a 25 call, and you pay, let's say, $1 for it, so break-even is 26. Does the stock actually have to get to 26 in order for you to make money with that option, or can you make option without the stock going to 26?
Well, at expiration, if you hold this till expiration, it has to be above 26. But there are ways to make money in the middle. And by the way, Joe, you do not have to hold this option till expiration. So if this stock has a little bump up, you can sell it anytime you'd like and take your profit and move on to something else.
Okay, so that's the key. You don't have to hold it till expiration. You can sell it at any time. I got you. All right. Peter, I want to go to you about your call spread strategy. I think you said something about being short the strike where you anticipate the stock to go to. Could you talk more about that?
Yeah, sure. And again, I could certainly go out and buy one call option and hope that the ETF goes from 25 to 500, like Bill was mentioning. But again, the reality of it is that's not going to happen. And so my plan is to always choose a strike price up on top, which is going to be close to where I believe the ETF is going to land. And again, selling that option to somebody else. And by doing that, I'm financing the option that I'm buying, which is really a good thing. And so once again, we're not only spreading off risk of volatility and time that I spoke of earlier, we're spreading off the cost of getting into the game. I'm buying one option, selling another option, and that is certainly favorable to me.
Okay, that makes sense. And hey, Bar,
Yes,
Brazil, if you're talking movement, I guess in some way you're talking volatility. What are some other approaches? I mean, would you consider things like straddles, long call and long a put? What are some different approaches there?
Well, again, this is a good one because maybe before the news came out earlier today, when there's I don't want to use the word volatility because that confuses people, but let's just substitute it for uncertainty. Okay? And so instead of you saying the volatility going up, let's say there's uncertainty. And the more uncertainty there is, the more premium there is to pay or to receive. The more premium there is in the option. And it really makes sense if you sit back because and I don't want to get I don't want to talk about personally, but I have my daughter who's perfect and my son who's a knucklehead. And I love them both equally. My daughter, I'll give her, she can drive the car, and they may charge her $500 per year for insurance. And my son, who's just 2 years younger, and he's knucklehead, I wouldn't write that policy. I wouldn't write that option on that. I might charge $750 because he's more volatile, and his moods are more volatile, and he's knucklehead. A lovable one. But my point is, so when there's uncertainty like there is in Brazil right now, people are going to want to charge a little bit more for premium. And it goes back to my point before. If you're a seller of the option, and as Pete was just talking about, you can get more premium for that. You can extract more from the market and then buy another option that may be less expensive, relatively less expensive, offsetting some of your risk. So going back to your question before, and I thought it was a very good one. If you buy an option and it doesn't move up to, I think you said 26 before, if it doesn't move to the price, can you still make money? Yes, you can, because sometimes when you buy an option and there's uncertainty or additional uncertainty in the marketplace, the price of the option will go up, allowing the seller to sell it, profit from that.
And as as options increase in value, guys, I mean, do you have strong feelings about, when options are overpriced, just sell them? Are we naked option sellers? Are we spread sellers? Talk a little bit about the risks associated with, selling high-priced options.
Well, you know what, Joe? I would say one thing before we talk about just selling high-priced options, and I think it applies to either both the sell side and the buy side, and that's about managing both your risk and your reward. So, when we buy that call, our risk is simply what we pay for it. Our reward could be, potentially unlimited. When we sell a put, our risk is limited. Our reward is limited to what the premium we bring in, and our risk is basically the risk of stock. Because if the ETF goes down, we get put the ETF, we end up owning it. It could go to zero. But risk reward is something that you have to manage throughout the life of the option. And the sell side, people who love to sell, I mean, that's great. You're bringing premium, but you have to do it in a very controlled manner. Selling puts, and as Barry mentioned, having the cash on hand, that controls that risk. We didn't talk about short spreads. I mean, short spreads are ideal because your risk is controlled by the long side of the spread. So I think it's all about controlling that risk and reward throughout the life of that contract.
I'd like to, and I don't know if Peter wants to inject something, but I think that it's really important that the investor understands when they buy something, and we're talking about something that's trading right now at $22.50, $22.50, that when you buy it or you sell it, that you understand what the next strategy is, where you will take a profit. So what I'm saying is that if you buy it for $22.50, and you have to say to yourself, am I happy making 10% on this investment over the next, and then you fill in time, whatever, 30 days, 60 days, 90 days, a year. Am I happy with a 10% return? And if it is, then you're going to be very happy selling if you're buying it at $22.50, $2.50 above that is $45. You sell a $25 call. If you're buying the underlying and you're happy when you're getting out. Excuse me for a moment because I have maybe you can fill in because I have an ambulance behind me. Okay, I apologize. Where the exchange is located next to the fire department. So I apologize.
We thought you were driving and doing this, Barry.
No. So, but to the point, it's that it's so important that when you do a trade or you make an investment, that you have a strategy in mind when to get out of it, how much profit you want to make, and how much loss you're willing to accept. And when it comes to that point, it's very matter of fact. It's very easy. It's mechanical. And I think that's what separates successful investors from people that get tied up in emotion.
That's a really good point.
Go ahead, Peter.
Yeah, Barry makes a really good point. Having the transition from being a floor trader to a retail trader that I am now, it's so unbelievably perfect. When I see a profit, which isn't all the time, I take that profit off the table. I mean, Joe, you've got this line in some of your presentations for the OIC, nobody ever went broke taking a profit. Because early on as a retail trader, I would see a profit and I would want that profit to run. Sometimes the underlying ETF goes right back where it started from. And gee, I could have put that trade on again for a second time perhaps. So I'm in the mode where I always take my trades off if I have an acceptable profit. Style, that's my style.
And that's
Peter,
why
that fits right in with the old saying on Wall Street: bulls make money, bears make money, pigs get slaughtered. Right? You have an idea where you're going to make money. You get to the point where you're making money. You make that money. You take that profit. You move on to the next thing. Absolutely.
And I know that sometimes emotion gets in the way. And if it does get in the way, what you do is if you agreed to yourself to sell it and you really are struggling with it, sell half and see how it feels. Or if you have a loss.
A good trader takes half, right? Yeah.
Yeah. You can only be half wrong. So these are the strategies that separate a successful investor or trader from people that I know Peter has seen and I've seen through my career, that you wonder what allows Peter to be, a viable part of the investment community today working with the CBOE. and Bill, who has seen many people's careers come and go. And I can't stress it. We can talk about options and option strategies, but you have to believe that the beginning is you have to be disciplined. And the only way to be disciplined is to have a strategy.
Speaking of strategies, we're touching on kind of the bullish side here. Before we roll into bearish and maybe some neutral ideas, who wants to talk a little bit about maybe a bull put spread versus, Peter, you talked about the long call spread. Somebody want to focus on the bull put spread and how it may compare with a long call spread?
Sure. I'd like to look at the bull put spreads, basically for people who like to sell options and bring in income. So you could sell this option, bring in a little income, and you're buying something else that's going to protect you on the downside. Now, if you sell a naked put, you have. I got a little confused. We're on a put spreads. I'm sorry.
You're on the right side. Yeah, you're good.
Yeah, I'm
you're
good.
good.
So we're gonna sell this put, and we have risk to the downside. We could end up buying the stock, but we have another put that protects us. It gives us the right to sell the stock should the stock go down too far. So we have an ability to make money here. With a credit spread like this, you can only make the premium that you bring in when you sell that option. And your risk is defined to the difference between the strike prices less that premium. So it's a very much a defined risk, defined reward. And if we look at that, we have the right slide up here. You could look at the P&L graph. You see those lines above and below, those red lines. That's your limited risk. On the downside, your limited profit on the upside. The thing that you have to remember about with these spreads is what happens when you look at the credit spread versus the debit spread is what happens at expiration, and that's where the real difference comes in when you get to expiration. If you're right and the stock goes up, the bull put spread will expire worthless. You'll keep the premiums. The bull call spread will go in the money, and you'll have to do something. You have to take some action to close that spread and collect that money, which is an additional cost.
All right. Anybody to add anything on that bull put spread idea?
But, yeah, I could add a little bit to it.
Go ahead, Pete, please.
Or go ahead, Bill.
No, go ahead.
Well,
Pete,
I was going to say, a lot of times with these credit spreads, it's good to put them on. A lot of the action is usually, around where the strike price is, along with the ETF, where the ETF is trading. Sometimes it's nice to trade these things out of the money. And what I look at, and not to get too serious here, but I think this is pretty basic. I like to look at where the straddle is trading, the at-the-money call and the at-the-money put. So listen carefully with this. I'm not going to try to confuse anybody. If I've got the at-the-money call is about $3 and the at-the-money put's about $3, I'm looking at the expected movement of the ETF during the life of these options to be about $6. So maybe I go out about $6 or more and do a credit spread just out of the range of where the expected movement is going to be. That's my thought on some of these credit spreads anyway.
I love that, Peter.
Good.
Barry, we're going to offer something?
Yeah, I just wanted to Bill just to continue. If you have the bull, if you now are short the closer in the money, and look, if you have the bull strategy on, what happens, Bill? Can you talk about what happens at expiration? Because it might not be a bad way to get into the stock.
Well, you could if the stock comes down a little bit, you're going to end up owning the stock because you have that short put. So you're going to end up owning the stock. And if your goal is to end up owning the stock, as we talked about earlier with the short put, then that's great. And you have that you have that stock, you have it at a cheaper price. And by the way, when you get to that point, if you don't want to own it, you still have the put where you can sell the stock. So it's a great way to look at both things. You don't have to exercise the long side. You could just accept the assignment on the short side and end up owning the stock.
Exactly right. Okay. Yeah. And then the next strategy is, and I think that were we talking about bear strategies? Or were we just talking about strategies in general?
Oh, well, we were kind of focusing on the bull side. Maybe one more before we go over to bearish, and that's that whole idea of the protective put. You're long that underlying. Some people call it the married put. Who's had some success trading, the
and that's
protective
where I was
put
going.
strategy?
So now let's say under the last strategy, you're long the stock. You're out of the money put that you're short, goes away, worthless. The long put goes out worthless, and now you're long the stock. So you have a choice. The next strategy is if you like the stock, you can do one of two things. You can buy a put against it and limiting your downside. Married put is exactly what you're talking about. So you own the stock and you own the put. Or what you do is you own the stock and you say, I'm going to be fine owning the stock, and maybe I want to sell an out of the money or an out of the money call against it, collecting some additional premium. And both of the strategies give you a certain, certain risk and reward. And again, as long as you know what your strategy is and what your pain points are and where you want to get out, it's manageable.
Oh, Barry, I like the idea of the married put, but I don't know that I like the idea of a married put when you buy the stock and buy the put at the same time. You're buying the stock because you think it's going up. I like the put as a protective put for a situation where you may be long-term bullish on the stock, but maybe short-term bearish because there's earnings announcements coming out, something's happening that may affect the price of your ETF. So you may want to buy that. You're still bullish on the stock, so you keep the stock, but you may want to buy that protective put just to give you a little comfort level that you sleep a little better at night.
Yeah, this is car insurance for Barry's kid.
Exactly what it is, car insurance. But see, I think that I think that sometimes, and this is really interesting, people can find certain pockets, ETFs, certain areas of the world, if they're geographic ETFs, they think that it's good, or certain industries, paper products, or maybe wood, if you think that we're coming out of a recession, but they're uncertain about the whole economy. So they think they really like the sector, but they don't like the economy. So you marry it with a put, and that's kind of where I see that strategy.
And
you're hedged against the overall economy, but you want to see your sector excel.
Barry, some option traders get worried all the time, or those that own an ETF or a stock even. And I thought you brought up a really good point a little while ago. You'll go broke buying these puts, to protect yourself if you're nervous about, the world events and so on and so forth. The point that you brought up earlier, though, I'd like just to touch on that one more time. You sell that out of the money call, and maybe Joe can turn us over to the collar perhaps, and you're financing that put, you're financing that insurance. I thought that was a good point that you brought up a little bit earlier.
It's a good strategy.
How's that, Pete?
There it is.
All right. Peter, why don't you go through exactly, for people who are new, exactly what that collar is and when maybe it's most appropriate.
Yeah, so you're a little bit nervous about upcoming events. We've got all sorts of things to be nervous about in the world today. And you've got to pick your spot. Sometimes what we do as option traders, we might go out 2 or 3 months for a period of time as to where we are concerned about. And the simple thing to do is just go ahead and buy a put option as insurance for the next 3 months or so. And those puts over time can be expensive. The farther out in time you go, the more expensive that put's going to be. So as Barry brought up earlier, why don't we also go out in time and sell an out-of-the-money call option, and that will help us finance the put as insurance on the particular ETF. So really what we're doing here with this collar strategy is combining 2 strategies in one. One is the protective put, and the other one, which we haven't talked about yet, we're going to talk about income-generating strategies, but the other one would be a covered call strategy. And when you're choosing the strike prices for the call or the put, you're also choosing 2 exit points, which is important. Remember, if I sell a call option up on top, I've got the obligation to actually sell shares. If I buy a put down below, no obligation, but I've got the right to actually sell shares down below. So with the put, I've got the right to bail, and with the call, possibly if the underlying goes up to that call strike price, I've got the obligation to sell shares as well.
Great explanation there, Peter. I was chomping at the bit to ask you the question, how do you pick a strike price?
Well,
Joe, go ahead, Peter.
Well, that's a great question. Sometimes, great question, because sometimes traders want to sell that call option to totally finance the put, or maybe even get a credit for putting this insurance trade on. That's not how you do it. You've got to have 2 acceptable exit points. So when you look at an options chain, look at the put. How far below is your pain threshold on the bottom? And up on top, how bullish are you up on top? Where would you like to bail up on top and have a very successful trade? So that's how I would choose those strike prices.
Yeah, Joe, I agree with Peter 100%. I look at it and I tell people, if you can do the collar, you have the opportunity to lose stock on the way up and the way down. Make sure you're happy with both those prices. Is the call price high enough? Is the put price high enough? Because if it goes too low, you lose too much money. So make sure you have enough upside for yourself and you have the protection you want on the downside.
Very good. How about if we roll into? I mean, we're talking a little bit neutral here. How about if we go to the bearish side? If we got an ETF or just an overall market that we're not positive on and we want some protection, who's got some ideas on the downside in terms of bearish option positions around an ETF?
Well, Joe, we hit that a little bit when we talked about the collar. I mean that's the protection right there, and the married put. But when looking on the bearish side, you just don't have the stock. So protective put, you have stock. If we're speculating on the downside, we're buying a put and we don't own the stock. So we'll do it the same way we did it before. I'll just say go out and buy that put, buy that out of the money put. Get the most leverage you can. Hope that the stock goes close to zero, but don't let it get to zero, because if it stops trading, you'll have a hard time getting your money out of the position. And then I'll let Peter tell you why you should do the spread, because the spread is also a great idea.
There you go, Peter.
Yeah, same thing. This reminds me back when we did the call spread, but now we're doing the put spread. What are we doing here again? We're having realistic expectations, this time, though, on the downside. And instead of just buying that put, now we're going to go down. How far down is this ETF really going to go? We're going to actually sell a put on the downside to finance the put, the upper strike put. So yeah, you bet. That's what we're doing, financing the protection.
And I think you speak to an important point about options. I mean, a lot of folks think, so complicated. Frankly, here we are. We're talking bullish, we're talking bearish, and yet we're talking really the same types of strategies with limited risk, limited reward. There can be lots of choices out there, but it would be a pretty good idea for investors to kind of limit those choices to the handful of spreads that they're most comfortable with, and that's what we're trying to go through tonight, a little discussion about lots of them.
But Joe, you make a really good point, and I think that we, Bill and Pete, and we take it for granted because we're very comfortable with these strategies because we can visualize it in our minds. But I think that for anyone that's starting, I believe that you can look at it. But if you trade an option, or an option spread, 1-and-1. And the moment, if you buy an out-of-the-money put or an out-of-the-money call, or if you want to do a spread strategy, buy one and sell one, and you may have, I don't know, you have, $0.75 at risk, 75 cents, which is $75. That moment that the investor or the trader does that will clarify it to you. Very rarely do I ever hear that when they do the trade, and they look at it and it's their money, as much or as little as it is, and I hope it's little, like under $100 to do this, it'll just become crystal clear to the person. And I know that people are very hesitant sometimes to do the first trade because they're so afraid of getting it wrong. And I know just per personal experience, the first trade I did was wrong, and that gave me, it actually taught me to be very careful and to understand what I'm doing, versus making money on the first trade, thinking that this is the easiest thing in the world. But I can't stress enough that it's so important that if you're thinking about it, to just start, do it. And if you have questions, use the options helpline, and people will help you along the way. And it'll crystallize for the investor or the trader.
Barry, I think you make a great point, but I would add one more thing. We talked about a couple of different strategies, and if you look at, we had I think 18 on that first slide. Don't as a beginner, don't try and understand 18 different strategies. Pick 2 bullish, 2 bearish, 2 neutral. And learn those strategies, or skip the neutral for a second. Just have a strategy on the bull side and a bearish to protect yourself. And get comfortable with a few strategies first, and then you can look at everything else that the option world offers.
And I'll even add on to that. Get comfortable with a few ETFs and not a boatload of them. Get acquainted to the
narrow that universe.
That's so important. I don't want to jump the gun. It is. And I think that, in this environment that we're in, currently in. We don't know what's going to happen in a few weeks, but we're currently in a zero interest rate environment. Very like a zero interest rate. It's very hard to find yield. But I just want to go back to, I always go back to an example, and not necessarily, but I'll go back to the Brazil example. In this case, the yield on this Brazil is 5.5%. I'm sorry, 4.5%. It's the yield on this ETF. Now, it's 4.5% because there's a lot of risk in it, and people are just trying to sell it, bringing the yield up. But if you're looking at some of your equities, the underlying stocks or ETFs that may have a 1.5% or 1.75% yield, there are strategies, and it could be, Bill, one of the strategies that you're looking at is a yield enhancement strategy to be able to, if you're going to own it, the ETF, sell out of the money calls to enhance your yield and bringing that up to some rate of return that you're comfortable with. So instead of just
owning that whole idea of a covered call a little bit.
Okay, please. I didn't want to hijack you.
Yeah, look. No, but you're right on the money, Barry. Look, we have a lot of people looking for income now, and a great income idea, and we cover the income ideas really in the neutral part of the presentation, because if you sell a call, you want to bring some income in, and we're going to sell an out of the money call, above the price of the ETF. We're not really bullish on that ETF because we don't want it to go through that strike price, because we want to keep the ETF. We don't want to be called away. So we're looking at neutral or moderately bullish or moderately bearish if we do this with a put. But we're looking to generate some income in an ETF that we don't think is going to go very far. But if it doesn't go anywhere, it stays kind of in a tight trading range, and we can sell a call and make some money on it, bring some increase income in our portfolio. That's fabulous.
It does, because otherwise you're just letting it go. You're being passive. I guess that's what it is. You can be a passive investor, owning equities or owning ETFs, and if that's your style, I think it works. It's worked very, very well for many, many people throughout history. If you are going to be and using options as part of your overall strategy for yield enhancement or risk management, you have to, number one, you have to be an active investor. It just doesn't work unless you're active.
Well, Barry, let's and Peter, please jump in, because you stood on the floor. I never stood on the floor, but I look at it as you could be not a trader and be somewhat passive and have your positions, and maybe you have ETFs that pay a nice dividend. You get this capital gain from time to time, and that's great. And then what you do is you sell a covered call every now and then to boost your return, or you get a little nervous and you buy that put for protection, and you're not really a trader, and you're somewhat passive, but you're not completely passive, because you are paying attention to your positions, which you should be, by the way, whether you use options or not. You should be paying attention to your positions.
Yeah, I mean, the plan with that covered call is to generate some income on a stock or an ETF that isn't, one that's just kind of hanging out, not moving. You're looking at it every day. It's like, hey, let's learn about options. Let's sell some of these call options and generate some income. It's there. It's doable. And, the other thing is, here we are, just talking all sorts of textbook and looking at these graphs and charts. If you don't believe us, go out, and I know you believe us. I'm tongue in cheek here, but go look at some of these options chains and see how they fit with some of the holdings that you have. Hey, these guys talked about a collar as protection. Let me go take a look at that. How would that price itself out for me? Maybe you don't want to put the collar on now, but at least educate yourself as to how to do it, because when you do get nervous, yeah, I know how to do this and how to pull the trigger on this thing.
My wife is a living testament, and I've been telling people about she is, because I've been telling people that it's silly not to do simple, writing calls against underlying holdings for years. And it's the craziest thing. My wife suggested it to some of her friends, and it's matriarchal families. The wives control the money. And now my wife has a group of women, her friends, that call her for advice constantly, and they're selling one or two or maybe three options against sometimes the kids' Disney stock, or it could be against Johnson & Johnson. And it is, they like the income generation part of it. My wife is very strict. She said, that's not spending money. That's investment money that you make. So it's not to go out and buy, lease a car. It's really made for it's investing, because it's the overall yield to just added yield. So, but as an investor, I am risk adverse, because I want to go back to my son and my daughter just for a moment. If my wife was to call me right now and say, Bear, our car insurance lapsed and we will have car insurance tomorrow morning at 9 o'clock, I would say, okay. And I would be calling a taxi or an Uber. I would not drive home this evening. And I feel the same way. And my car is what, a $25,000 car. I would feel the same with a $25,000 or $30,000 portfolio. Not to have insurance on my overall portfolio would be, it's just not acceptable to me. So I think options in some cases they're a way of managing risk. So just on that light, that's how I feel about it.
Some of the more maybe sophisticated option users, look to the market to try to take premium out of the marketplace. We talked about covered calls. We talked about some credit spreads. How about something, like the Iron Condor, a calendar, or time spread? These are different ways where, we let some of that premium come to us within a particular range. Who wants to speak to, some neutral strategies? Don't all jump at once.
Well,
difficult for me.
Well, you know what, Joe? I'm glad you prefaced this by saying that some of our more sophisticated options users, and I look at like you have the Iron Condor up here right now, and I look at the Iron Condor and you just took it away, but the calendar's fed up. But the Iron Condor, you got to look at it as two spreads, and I try and break it down that way. It's two different spreads, and when you look at this, the graph that's up here, you see that you make money above the line in the middle, and you can lose money on the upside and the downside. So it's a very neutral strategy. You're making money in a very tight range with the stock, and you have a limited upside, but you have downside on both sides if the stock goes up and if the stock goes down. So it's a strategy that you have to monitor. We talked about passive investing, and if you're a passive investor, you do not want to be doing condors, butterflies, or iron butterflies or iron conduits, because it's something that you have to pay attention to at all times. Now, if you're very certain that the stock is to stay in this range, these are a great way to make money.
But the one thing about something like the Condor is that it does have predefined risk limits, which can allow for as you say, Bill, you have to manage it, but you do have a predefined risk, which is, I think, pretty important.
Oh yeah, it's not going to come back and kill you. Because you have four parts here, you have a lot of things going on, and you may want to close one of the spreads out, leave the other one alone. It's really something that you have to pay attention to. But like you said, the predefined risk makes it a little bit easier to do.
How about the calendar or time spread? Actually, that one used to be one of my favorite spreads on the floor. Who wants to speak to why to do something like that?
I will. It's funny, Joe, that's my favorite strategy from the floor. What we're doing here is selling front month premium and buying something farther out in time to protect ourselves. And what are we doing when we sell the front month is this. We're selling that time, that acceleration of time decay that happens with those front month options. Remember, as options approach expiration, the time premium erodes at an accelerated pace. So we want to take advantage of that accelerated pace with that front month. But there's two things. Barry's been talking about his family. I'm going to get really personal here, too. I'm afraid of selling naked call options, and I'm afraid of elevators, all right? So there you go. But I don't like to sell. There's no way in the world I'm going to sell call options in the front month and buckle up and hope. No, I'm going to sell call options in the front month and buy call options further out to protect myself on that upside should that upside happen.
Okay, I'm with you, Peter, completely.
Peter, that was I have to admit that was the way I learned how to trade options were call spreads.
Yeah.
Time spreads.
And Joe, it's the same way for us on the trading floor. This was a lot of these strategies that we're talking about today mean nothing on the trading floor except maybe taking the opposite side of that trade. This was definitely a market maker type strategy for sure.
So, and one component of the time and calendar spread was volatility. I think pretty soon we're going to roll it over to some attendee questions, but I think we'd be remiss not to talk vol a little bit and vol positions before we go to questions. How about straddles, strangles? I just popped up the long straddle. What's key in a position like this from a volatility standpoint?
Higher expectation of higher volatility than is currently trading today.
And I would say, go ahead.
And let me say, just higher and a movement that is going to be greater than what is being forecast of the uncertainty. I'll use uncertainty again. That when you look at the uncertainty and it's priced, you see, as Peter said before, that it looks like just by uncertainty it's going to be priced between a high and a low number. It's crowd mentality of pricing these options will tell you what the crowd believes would be the high and the low on the stock. That is what it's telling you, and the crowd is many, many times correct.
And you know the way I've always looked at it, Barry?
Yeah,
I've always looked at it as something big is going to happen. I don't know if it's going to be up or be down. And if something big is going to happen, that means that I'm looking for a big move. I'm looking for a big change in volatility. So I've always looked at it not from the volatility side first. I've always looked at it from the stock side first and said, I'm going to buy this straddle because I don't know if the stock is going up or going down, but whatever it is, it's going to be big. And if it's going to be big, that means a big increase in volatility.
That's it. And it's funny, Bill, because new option traders come up to me sometimes at the end of an OIC seminar some evenings. They'll say, hey, Peter, I got this whole game figured out. I'm like, well, gee, I don't. Help me here. Hey, what if I buy a call option? I make money if the stock goes up. Sure. And if I buy a put option, I make money if the stock goes down. Well, that's a straddle. But I always tell them, and that's what you guys are all talking about, you need one or two things to happen, either a big move in the underlying or a big spike in volatility. And if you get that big spike in volatility after you put this straddle on, I'm out. I'm gonna unload that thing and take my profit and run, because sometimes you don't get the movement. And we're talking about, with stocks, we'll talk about earnings or something perhaps, but sometimes the movement just doesn't occur. And the break-even points are very interesting to me with the straddle, because the market, as Barry is talking about, is pricing in a move of about 5 up or 5 down, depending on the combination of the call and the put when you add them together, and that's basically the break-even. So for me, I'm not a big fan of buying straddles. You're buying a lot of time premium, and we know that time erodes over time. So,
yeah,
well, I feel better having a little bit of a volatility conversation. Thank you, guys.
Yeah. Oh, the long strangle. That's the poor man's straddle, right?
There you go. And what is the difference, Peter, with a strangle versus a strangle?
Well, the straddle, you're going after the at-the-money call and the at-the-money put. With the strangle, you're going out a little bit further with the strike price on the call and the put, so it's going to be a little bit cheaper to put on. But with that being said, you're going to need a bigger move than you would with a straddle. And, the volatility might not be quite as great with those out-of-the-money options as well.
Okay. Good explanation. Thanks.
I think
any other strategies that you guys want to touch on before I bring in Nick for some questions?
I just want to make, I think, an interesting exercise for the people that are looking at it. I think that it's interesting if you look at a highly volatile stock, a stock with a lot of uncertainty, before earnings is released, a day or two before earnings are released, and you look at the at-the-money call and put, look at that straddle to see where it's priced, and you add the call and the put, and then after the earnings are released, see where the stock moves. So you can
Amazon would be a good example for them, Barry, to take home with them. And Amazon earnings period is just classic for what you're talking about.
And what is the symbol for that?
AMZN.
Perfect. AMZN. And that's what I think that you have to just be comfortable with it. Thank you for that, because I think that we've been remiss, and I think that the advisor community. I know that my advisor helps me in my option strategies. It sets him apart from the other advisors in their practice in the office. And I think that the advisors, and I know that OIC is supporting the advisor community. If advisors there are looking for something to set their practice apart and to be able to give their customers investment and investment advice and managing risk and increasing yield, I think that this is a product that they really have to seriously explore. But back to you.
Couldn't agree with you more.
Good point, Barry. All right. Well, Nick, are you with us?
I am, gentlemen. I'm right here. It sounds like we've got some great back and forth going on. I know we talked about a lot of different strategies today, and I hope our listeners have been able to glean some information out of that. We've covered both the bullish, the bearish, and the neutral side. But let me put it to you, Joe, and I'll let you disseminate this question among our panelists as you see fit. Let's keep it simple. For an investor who's looking to kind of break into this, what's going to be a better approach? Buying calls and puts, or doing spread trades?
Buying calls or puts or doing spread trades. Bill Ryan, you want to give that a shot?
Yeah, you know what, Joe? I think that somebody that's coming into the options marketplace will have a hard time doing spreads because you're going to have levels at the brokerage house for approvals, and usually spreads takes a little higher experience level to be approved for spreads. So you're going to be in a level where you can either do buy rights or buy calls or buy puts. It always struck me as odd because the spreads are less risky than just straight out speculative buys, but some brokerage houses feel that you need a little more experience to understand what happens in a spread. So I would say start with a couple of calls, buy a couple calls, buy a couple puts, see how they react with the market going up or going down, and then work quickly to get to spreads because I think you can be better off with a spread than you can with a straight call or put buy.
Okay, that sounds like good advice. One thing I would add, and popping it up a little slide here is, at optionseducation.org, we do have that position simulator. So you can put in your underlying price, your volatility, but that may be in there for you. And then depending on your forecast, you can see where that call or put may go, depending on the amount of movement in the underlying. So that's the position simulator at optionseducation.org. Nick?
Guys, we've had a lot of the attendees today asking about very specific questions about a lot of the different approaches that you've taken here today. Let's try to break it down to some more simple things. Based on the three different approaches with the bearish, the bullish, and the neutral strategies, how is an investor supposed to know what the best option strategy is to use with a given underlying forecast?
Well, we'll give the easy question to you, Peter.
I thought that was the easy one. I was going to jump
in.
Well, Nick,
the magic sauce.
That's the toughest part. I mean, first of all, the decision on what the underlying is going to do is a very difficult one. And one of the other guys earlier mentioned, you don't have to get your arms around all 28 or 32 strategies, but pick out 2 bullish, 2 neutral, and 2 bearish, and get comfortable with them and get comfortable with the mechanics of those particular trades. And I mean, with that being said, it really comes down, and it's very difficult. I mean, coming from the trading floor, this might sound odd, but it was a lot easier on the floor than it is being a retail trader, because on the floor, the trades came to you, and you had to manipulate it into such. Maybe it was a calendar spread that Joe and I liked. But for an options trader, a retail trader, you've got to, number one, what's the stock going to do? That's tough. And number 2, how long is it going to take to do it? And then what is your expectation on volatility? I know we just touched on volatility briefly, but here's volatility. When volatility is higher, both call and put premiums are higher. And when it's lower, they're lower. So you've got to have, there's a lot of moving parts is what I want to say. And to answer the question, get comfortable with 6 strategies to start out. How's that?
Bill or Barry, you want anything to add there?
Yeah, I just think that I want to go back to what I said before. It may seem complicated, but it's not. If you have a reason that you're getting into a position, it could be a stock, it could be an ETF, and then the moment you get in, you have to decide when is your exit point. And once you decide your exit point, the strategy will come easily to you to execute that. So,
Barry, I'll make it even more simple than that. Go out and get yourself a really good crystal ball.
Like an 8-ball, the one you shake?
Yeah. No, I agree with everything that Peter and you just said, and it's about managing the expectations and managing the risk and managing the reward. And a lot of strategies will work a lot of times, and a lot of them won't work in certain situations. And the stock is the key. If you're wrong or the ETF is the key. If you're wrong on your prediction on the ETF, the option strategy will not work the way you think it's going to work.
It's and I'll give you a live example. I may be yelled at from my Nasdaq management, but a few weeks ago I was reading about Alcoa Aluminum, and I'm looking at it and saying, Alcoa Aluminum seems like a really good company. Finished aluminum product, making airplanes. It's not a commodity. It's like they're finished aluminum. It's like they're making, like I said, airplane skins, things like that, highly technical. I said, and it's just being crushed with the commodity prices around the world. And I said, I really want to own some Alcoa. And what I did is I had an option strategy to get me long Alcoa, thinking that if I get long it, I'm going to be perfectly okay owning it. And it was around, $10 or a little over $10. And I got into it. And Alcoa today is trading lower. And it doesn't bother me because I'm still, the options are still on. And if I am owning the stock in 30 days from now, I'll be okay because I will then just change my strategy and just reverse it. I'll sell out of the money calls against my long stock position, capturing it that way. But because I know what my strategy is, there's very little anxiety for me because I know in the long run, I know I will be right. But I had no idea.
You have a plan.
I'm wrong now. Yeah, I'm wrong now, but it doesn't upset me because I still believe the reasons I got into owning this are good and solid for me, not anyone else, just for me and long-term investor. So as long as you have a strategy and you follow through on your overall strategy, I think that, the anxiety goes away for me, which was not the case when I was on the floor. And I agree with Peter and many of what you say. You were reacting.
Right.
So,
And Barra, you just speak to doing your homework and then having a plan, and that's critical for every approach in investing. Nick, maybe time for one more quick one.
Well, we are a little bit over time, but I'm sure that we can get one more question in there. So we'll put it to I don't want to say this is more simple because we could get into the nitty gritty of it, but is it going to be better to trade options from the long side or from the short side? What's better to do as a beginning investor? Let's say that.
Who wants to take that?
Well, I'll go back to what I said before with the spreads. I think from the short side, a beginning investor will have a difficult time because a brokerage house might not give you the approval you need to begin on the short side. So I think you're going to be forced to begin from the long side. And so I would go back to what I said before, go that long side and then bring the short side in the form of spreads. And then once you get comfortable doing that, then your brokerage house may allow you to do cash secured puts and credit spreads.
That makes sense, and I think Bill, Barry, and Peter. With that, we're gonna wrap it up. I'm going to turn it back to you, Nick.
Great, gentlemen. Thank you so much for your expertise and time. And ladies and gentlemen who are listening, I know that we did have some questions that we were not able to get to, but I hope this was very informative. And please use the investor services team at the OIC. You can always contact them at options@theocc.com if you have questions about different strategies that were discussed today or your options positions. And as I mentioned, today's session will be archived and accessible in a few hours using the same link you used to join us today. And we have previous webinars available on the OIC YouTube channel, so you can review those strategies and concepts at your own pace. And please do fill out those surveys. Those responses are extremely valuable to us and will help guide our 2016 webinar series. And with that, Joe and panel, I will turn it over to you guys if anybody has any closing remarks for our listeners today.
Bill?
No, I just say thank you for attending. I hope you've got something useful from us today. It was my pleasure to be here, and good luck in all your option trading.
Barry?
I just want to thank everyone for the time, and I really appreciate Bill and Peter. I know how busy you guys are. Thank you for doing this.
Peter?
Yeah, I'd like to thank everybody as well as Bill and Barry. Remember that trading is an art, not a science, and it's going to take time. This retail thing is going to take you. If you're a retail trader, you're going to trade these ETFs, whatever it is, it's going to take you a couple of years to gather all the proper information to be good at it.
Great advice, guys. Nick, thanks for your support all day long. I'll turn it back over to you.
Gentlemen, thank you so much for your time and expertise. I know we've got decades of experience on the options side over here. I hope our listeners learn something from them, and please do contact the OIC team at options@theocc.com, and make sure to check optionseducation.org in the upcoming months as we start planning our 2016 webinar and seminar schedules. If there are any financial advisors on our webinar today, the IMCA program ID for continuing education credit is 15BOE002. That's 15 Bravo Oscar Echo 002. The FPA program ID is 221309. That's 221309. Ladies and gentlemen, thank you for attending, and we hope to see you again next time.